and welcome to our special series, GST One Step Closer. Today we concentrate on what markets are watching in this bill and how investors must be positioned before this new national tax regime comes in. But first things first, at the moment, the first positive step is that the Congress has indicated a breakthrough in its talks with the government on the GST. The AIADMK, another opposing party, has also said to CNBC TV 18 that 7 out of its 10 demands have been met. Now the passage of the GST bill, the amendment bill that is, looks almost likely in the current session of Parliament, and of course it is, we now know, going to be introduced in the in the Rajya Sabha next week. However, we must remember that there are more hurdles. A central GST bill needs to be passed, quite distinct from the amendment, and thereafter the states have to agree on the state GST rate. A GST rate of 18% will impact the market differently from a GST rate of 22%. So, let us get in experts to tell us what stocks you have to watch, who will be impacted positively, which stocks negatively, and where can the ambushes lie. I have with me Mahesh Nandurkar of CLSA, Tanvee Gupta Jain of Macquarie, and Gautam Chhaochharia of UBS. Gentlemen and lady, welcome to the show. Well, first up, the government has listed the bill that is the amendment bill for consideration and passage in the Rajya Sabha, but that now looks imminent because most of the opposing parties, the Congress and the AIADMK, seem to be falling in line. So, assuming the amendment bill is in place, Tanvee Gupta, let me come to you. What should we prepare for? Is this a big harbinger of growth?
I would say GST, if it actually passed through, because as we have been speaking about, the passage to GST is more political than economic at this point of time. But if GST actually comes through in the Parliament next week and we saw, a positive bearing on GST, I think it's very positive for economic growth. Yes, in the short term, both the parties, be it government or be it the private sector, will be adjusting to the complexities of the implementation which the GST will bestow upon us. But I guess in the medium term, I would say it is largely positive. We are actually estimating, depending upon where the GST rate actually gets fixed, to GST to have a positive multiplier impact on the economy to the extent of 70 to 120 basis points, which I guess will be significantly positive considering that India is on the growth path and we need to augment revenues, we need to improve ease of doing business, and we are trying to showcase India in the Make in India initiative. So I guess from the economics point of view, implementation of the GST is actually pretty positive from the medium term perspective. 70
to 120 basis point positive impact on the GDP, you say. But have you all made any more fine distinctions, like if it is a 18% GST rate, what may be the impact? If it's a 22% GST rate, what may be the impact? Or is this an overall study?
Okay, so it depends. So this, if you look at the wide range which we are talking about, 70 to 120 basis point, is on the assumption whether the GST rate is 15%, 18%, or is it pretty high at 22%. So in that sense, what are the exemptions given on GST, which all components are part of GST, be it alcohol, petrol, how much time the states are getting compensated, when actually you can see the full implementation, what are the exemptions, especially on, and what is the exact tax rate on, say, the essential items from the standard goods and services, as well as the sin or demerit rate which was suggested by the CA committee.
Fair point.
So on that basis.
Okay, fair point. So a more minute impact on the GDP will depend on what is in the GST. Actually, Mahesh, why don't you come in on that? What will be the details that you will watch out for assuming that the amendment bill will be passed, since now it looks very imminent?
So the thing is, while the Constitution Amendment Bill might, get passed in this session, there are various other details which will still not be known, along with this, and we might have to wait for subsequent meetings of the GST Council or maybe the drafting of the GST Act in itself. But yes, all those things put together, what we would be very keenly watching out for would be, one, what is the standard GST rate. If the standard GST rate is at about 17 to 18%, then I think the market will continue to stay excited. But if the standard GST rate starts to go above 20, at or above 20%, then a lot of market enthusiasm on the GST itself, might come down. So that's one thing to watch out for. The second thing to watch out for is, what are the kind of, flexibilities that have been offered to the states. Because, what I understand is that the states are bargaining for, more flexibilities, in terms of the ability to kind of tax a certain commodities or otherwise, and even on the rates, I am told. So we'll need to watch out for that, because higher the flexibility is given to the states, lesser will be the effectiveness of the GST.
No, I agree with you. The devil will lie in the detail, and the big bill is the GST bill. We are at the moment still with the amendment, which only gives the right for the centre to tax, to put sales tax, and the right for the states to tax services. The actual rate is not at all there in this session of Parliament. Gautam, I found your report most interesting because you'll have done an analysis on what will the companies gain depending on the introduction of the GST. Can you take us through this upside to the NPV of companies analysis that you have done?
Yeah. So firstly, we are less worried or excited about what the GST rate would be. Because one, the GST rate is a very complex thing, and the various expert committees have given a very wide range of recommended revenue neutral rates. So to us, the initial RNR which the government announces will not be the final one. It's very likely that once they implement in 3 to 6 months, it is changed. Because to get the perfect RNR where there's no impact on tax revenues, or either way, because if the government over collects tax revenues in the short term, it could hurt consumption and be inflationary. If it under collects, it has fiscal pressure. So it's very likely that it will get revised within the 3 to 6 month period after the rate is implemented. In terms of impact on companies and profits, in our view, the bigger delta is where the informal segment gets squeezed out because they get brought into the tax net, and lesser in terms of the lower effective tax rates, because the lower effective tax rates is very likely to be competed away. But if you look at various different segments, so we've looked at different segments of businesses from tiles to apparels, etc., where there is a big unorganized segment, and their percentages vary. So in some segments, 50% of market, some 70%, some 20%. And if we assume scenarios of this informal segment getting squeezed out over a period of 5 years, 10 years, which is also fairly aggressive because you don't know for sure that the informal segment doesn't pay tax at all. But even if you assume that they get squeezed out, the impact on NPV for the organized players would be around 20 to 50%. While most of these sectors and stocks have re-rated a lot more over last 2-3 years, and even over last 3 months, they have re-rated in general by 25%. So theoretically, it looks like the GST upside is getting priced in. It could be more like buy on expectation and sell on the actual event. Having said that, as we are seeing in the broader market right now, the multiples can sustain if the environment is conducive and the risk on environment is there, in which case these stocks can still deliver you returns over the next 6 months to 12 months. But fundamentally, at least looks like it's getting priced in to the so-called GST beneficiaries.
Okay, if you could just elaborate on the exact sectors. Your main thesis is where there is a large unorganized sector, those companies are likely to benefit. So exactly which would they be?
So it will be apparel, tiles, home improvement in the durable side, appliances, entertainment, movie theaters, etc. These are the key segments.
Okay. Well, I could read out, I know you don't talk stocks, but your report says that in apparels, you would look at Page Industries, in ceramics, you will look at Chhaochharia Ceramics, in durables, you're looking at Bajaj Electricals, Havells, and such like, paints, of course, Asian Paints. Then personal care, you have all the FMCG stocks that interest you. Packaged foods would be very important. I would assume there will be a lot of unorganized players there who are currently not paying tax. So there, Britannia, Dabur, HUL would benefit in terms of, and of course, quick service restaurants like Jubilant Foods, according to this UBS report, would be benefited. Well, let me get to Nandurkar on the same issue. Mahesh, which sectors do you expect to be positively impacted?
I think the rates that will be the sectors that will be positively impacted are clearly going to be like pretty much all the manufacturing goods, because the basic understanding here is that the tax rates on the manufactured goods will go down and the tax rates on services will go up. So I would say that should be a positive for staples, autos, cement, and a whole host of other household products. Basically the entire manufacturing space, I would say.
Okay. Well, that's a handy list to work with. Let's do one thing. We'll take a break. When we come back, we are going to discuss what may be the negatives. Let's be aware of the ambushes. We are back in a minute.